Assalamualaikum dan salam sejahtera to all of you. How are you, students? I hope that you are in the best of health. Let us start the module by concluding what you have learned in the previous module. In the previous lecture, we explored the fascinating realm of financial management. We began the module by understanding the types of financial markets and business organization. And then, we discussed the second objective of understanding the goals of the firm, which include maximizing shareholders' wealth, enduring profitability, and managing risk. Furthermore, we delve into understanding the functions of financial manager such as forecasting and planning, investment and financing decisions, controlling and coordinating, as well as the last function, which was dealing with the financial market. Finally, the last topic was to understand the risk and return relationship. By the end of the module, you have gained a solid introduction to financial management. Armed with this knowledge, I believe you are now better equipped to make informed financial decisions, whether you are a student, a business owner, an investor, or simply interested in understanding the financial world. Alright, students, for this module, we would like to welcome you to watch and understand this captivating lecture video on understanding financial statements. In this module, we will continue to explore the exciting field of financial management, delving deeper into the topic of understanding financial statements, which is the heart of finance. We will navigate you to understand the statement of financial position, to know the statement of financial performance, and later to identify the sources and uses of funds and construct the cash flow statement. Remember, learning is an active process, so feel free to take notes, pause and reflect, and engage with the content. We encourage you to ask questions, seek clarification, and actively participate in the discussions. Your engagement will enhance the learning experience and contribute to a richer understanding of the topic. We will start our first lecture on the first topic, which is on understanding the balance sheet. But before we dive into that, let's take a moment to understand what financial analysis is all about. To begin with, financial analysis can be defined as a critical process of collecting and refining data in providing necessary information, aiding decision-making, and later determine future course of action. From this definition, you can see that the crucial part is to interpret and make sense of the numbers presented in financial statement so that we can better understand how a company is performing and make informed decisions about its future prospects. Financial analysis is essential for various stakeholders, including investors, creditors, managers, and even employees. Let's take a closer look at why it is important. For investors, financial analysis provides valuable insights into a company's profitability, growth potential, and risk levels. It helps them evaluate whether an investment is likely to generate a satisfactory return and aligned with their investment goals. For the creditors, such as banks or suppliers, they use financial analysis to determine creditworthiness and repayment ability. They evaluate the company's financial stability before extending loans and granting credit terms. Next, the use of financial analysis for the managers is to evaluate their company performance, identify areas for improvement, and make strategic decisions. Lastly, for the employees, they can benefit from financial analysis as it provides insights into a company's financial health. It helps employees understand their organization's financial stability and potential opportunities for growth and job security. Now that we understand the importance of financial analysis, let's briefly touch upon its components. As you can see from this slide, financial analysis involves analyzing financial statements such as the statement of financial position, balance sheet, statement of financial performance, income statement, and cash flow statement. These statements provide a snapshot of a company's financial performance and position at a certain period. The statement of financial position, also known as the balance sheet, is a crucial financial statement that provides a snapshot of a company's financial position at a specific point in time. It represents a summary of company's assets, liabilities, and shareholders' equity, illustrating the overall financial health and solvency of the business. The statement is called the balance sheet because it follows the fundamental accounting equation which assets equals to liabilities plus shareholders' equity. The equation signifies that a company's assets are financed by either liabilities, the obligations to external parties, or shareholder equity, ownership interest in the company. The assets represent the resources owned by the company that have future economic value. They can include current and fixed assets. On the other hand, liabilities are the company's obligations or debt to external parties. They include both short-term liabilities and long-term liabilities. Lastly, the shareholders' equity represents the residual interest in the company's assets after deducting liability. It includes the initial investment by shareholders and retained earnings, which are the accumulated profits or losses of the company over time. Now, we are going to dive into the world of finance and take a closer look at an essential financial statement called a balance sheet. As mentioned previously, the balance sheet provides us with a snapshot of a company's financial position at a specific point of time. So, let's break down its format and understand how it works. Okay, here is the typical format of balance sheet, and worry not, we will go through each section step by step. As you can see here, at the top of the balance sheet, we have the heading. This includes the name of the company, the title, statement of financial position, and the specific date or period covered. It is important to note that the balance sheet represents a particular moment, like the end of the fiscal year or a specific quarter. Okay, students, at the bottom of the balance sheet, we have the asset section. This section lists the company's assets, starting with the current assets and followed by non-current assets. The assets are usually presented in descending order of liquidity. Here, the company lists what it owns or has control over. The current assets are items that are expected to be converted into cash within 1 year. Current assets typically include cash, account receivables, inventories, prepaid expenses, and marketable securities. For cash and cash equivalents, it refers to the physical cash as well as highly liquid assets that can be easily converted into cash, such as bank accounts. On the other hand, the account receivable represents amount owed to the company by its customers or clients for goods and services that have been delivered but not yet paid for. Next, what do you understand about inventory? Okay, inventory can be considered as the raw materials, work in progress, and finished goods held by the company for sale or use in production. In addition, the company's assets also include prepaid expenses, which refer to the expenses that have been paid in advance but have not yet been consumed or used up. Examples include prepaid rent or insurance premium. Lastly, the company might also have marketable securities as their current assets. Marketable securities or short-term investment are tradable financial instruments that the company holds for investment purposes. Okay, students, these are the examples of current assets that a company normally holds for some period. The current assets are important because they represent the company's ability to meet its short-term obligations and fund day-to-day operations. By summing up these components, we arrive at the total current asset of a company, where it represents the collective value of all the assets expected to be converted into cash or used up within a relatively short time frame. Okay, students, now I hope that you are clear on the meaning of the current assets. Let's go to the non-current assets section. The non-current assets is also known as long-term assets or fixed assets. Unlike current assets, they are expected to be converted into cash within 1 year. Fixed assets have a longer useful life and are held by the company for production, use in operations, or for rental to others. As you can see here, some of the examples of fixed assets are properties, plants and equipment, vehicles, and intangible assets. Okay, students, the property includes land, building, offices, and warehouse owned by the company. Property normally represents a significant investment and is typically used for conducting businesses operations. Okay, students, now we will discuss the plant and equipment. The plant and equipment are the tangible assets, assets that you can touch and see, that are used in the production process. It includes machinery, tools, computers, furniture, and vehicles. These assets are necessary for the company to manufacture products and provide services. Next, the vehicle under the fixed asset is necessary for the company as it is a means for transportation or delivery purposes. Whether it's trucks, vans, or specialized vehicles, these assets help businesses move goods and reach customer efficiently. Finally, we have intangible assets. While not tangible in nature, they still fall under the category of fixed assets. Examples of intangible assets include patents, trademarks, copyrights, software, and license. These assets provide exclusive rights, competitive advantages, or valuable intellectual property to the company. For example, McDonald's, who own its iconic Golden Arch logo or its brand name. This trademark represents valuable intellectual property that distinguishes McD from its competitors and contributes to brand recognition and customer loyalty. So, by summing up the values of these different components, we arrive at the total value of fixed assets for a company. Remember, students, to calculate the total assets, we need to sum up the values of both current assets and fixed assets. Now that you have understood the meaning of current asset and fixed asset together with their components, we will now discuss the liability section of the balance sheet. So, what exactly are liabilities? The liabilities represent the company's obligations or debts to external parties. They are the claims that others have on the company's resources. The liabilities section starts with current liabilities and is followed by the non-current liabilities. Current liabilities represent the company's short-term financial obligations or debts that are expected to be settled within 1 year. Let's now take a closer look at some examples of liabilities. We will start with the current liability first. Okay, class. First, we have accounts payable. These are the amounts owed by the company to its suppliers or vendors for goods or services received but not yet paid for. It's like a company's IOU to its suppliers. For example, imagine a company orders raw materials from a supplier. The supplier sent an invoice for the materials, but the company hasn't made the payment yet. That outstanding amount becomes an account payable liability. Next, we have accrued expenses. These are the expenses that the company has incurred but hasn't yet paid. Common examples include accrued salaries, interest, taxes, or utilities. They represent obligations that the company needs to settle in the future. Let's say a company pays its employees monthly salaries at the end of each month. If we are in the middle of the month and employees have already worked for their salaries, but the payment hasn't been made yet, that unpaid amount becomes an accrued salary liability. Okay, class, now we go to the notes payable. The notes payable are loans or promissory notes that the company has taken and is obligated to repay to the lender within a specific time. It represents the borrowing of funds that the company needs to pay back. For instance, if a company obtains a loan from a bank to finance its expansion plan, the loan amount becomes a notes payable liability that the company needs to repay, usually with interest according to the agreed terms. So, to recap, totaling current liabilities involves identifying and adding up values of current liabilities for a company. This total represents the collective amount of the company's short-term obligations. Okay, now, have you ever wondered about what obligations a company has that extend beyond 1 year? Well, let's dive into the long-term liabilities. Long-term liabilities include loans or bonds with repayment periods extending beyond 1 year, and it represents the portion of a company's debt that is due for payment over an extended time frame. Companies often issue long-term debt instruments such as bonds to raise capital for significant investment or expansion projects. The principal amount of these bonds, along with any interest payments, becomes a long-term debt liability. We also have mortgage as one type of non-current liabilities. For your information, a mortgage is a type of loan specifically used to buy real estate like a house or buildings. So, to sum everything up, liabilities on the balance sheet represent a company's obligations and debt to external parties. They include account payable, accrued expenses, notes payable, customer deposits, long-term debt, and mortgage. When you total up all these items, you will get total liability. Okay, now we will be exploring another essential component of the balance sheet, which is equity. Equity represents a crucial aspect of a company's financial position. Let's explore into it. As we have discussed earlier, a balance sheet is a financial statement that provides an overview of a company's financial position at a specific point in time. It consists of two primary sections, which are assets and liabilities, and equity is the third component of the balance sheet. For your information, equity represents the ownership interest in a company. It reflects the residual interest in the company's assets after deducting its liability. In a simpler terms, equity shows how much of the company belongs to its owners or shareholders. Now, let's break down the key components of equity found on the balance sheet. First, we have common stock. It represents the capital contributed by the shareholders in exchange for ownership shares in the company. When individuals invest in a company by purchasing shares, they become shareholders and hold common stock. Next, we have preferred shares as one of the equity types. Preferred shares, also known as preference shares, are a type of ownership interest in a company. They have characteristics slightly different from common shares. Additionally, we have paid in capital. This represents the amount shareholders have contributed to the company more than the par value or the initial offering price of the shares. It includes any capital raised through stock issuances above the nominal value. The next element is retained earnings. Retained earnings reflect the accumulated profits or losses that a company has retained over time. It includes the net income the company has earned minus any dividend paid to shareholders. Another component in the equity section is treasury stock. Treasury stock represents the shares of a company's own stock that it has repurchased from shareholders. It is recorded as a negative value in the equity section since it reduced the overall ownership interest. So, by summing up these components, we arrive at the total equity of a company. So, students, how to get the total liabilities and equities? It's simply adding up the total liabilities with the total equities. Okay, everyone, you now have a solid understanding of the components of the balance sheet, which consists of assets, liabilities, and equities. Keep exploring and learning, and we will see you in our next chapter.